Kia ora all. I think we're ready to kick on. Are we on? No mai haere mai, ngā tahu, te whare o te Waipounamu. Yeah, welcome today, or tonight actually. It's awesome to see you here. I'll introduce myself first. So, tēnā koutou katoa, ko ngā tahu tōku iwi, ko Moiraki rawa ko Taumutu oku runanga, no o te tahia hau, he kai whakahare mātua o Whairawa, ko Sam Keller hau. So I'm Sam Keller, I'm the General Manager of Whairawa, which is the Ngāi Tahu Investment Scheme. It's awesome to see you all here tonight and welcome you here. So we love these opportunities to connect with Kaimahi and whānau. And this event tonight is also the kick-off of Sorted Money Month. So we've got a range of events over the month which we're excited about. So this one's kicking it off tonight. Cool, since we're an investment scheme, as I said, I should also give a disclaimer. So we're not giving financial advice tonight, so it's just all kind of general information. So I should cover that off. And Kendall, who's on our panel, actually is on the board of the Financial Markets Authority. So definitely need to make sure I said that. But cool. Anyway, so I'm Sam. I've introduced myself, but it's not about me. So I'll introduce our mighty fine panel for tonight. So I'll just introduce them quickly, then I'll let themselves introduce themselves. So we've got Sam Inglis, who was the General Manager of Investments at Ngāi Tahu Holdings, but now you're our Acting Chief Operating Officer. I'll let you talk more about yourself in a second, Sam. Got Kendall, who's an amazing Ngāi Tahu wahine, who's co-founder, co-CEO of Banker. And we've got Paul as well, who's currently the Financial Advisor at Craig's Investment Partners. So I'll hand over to Sam first just to say a few words about yourself and what you do.
Kia ora koutou everyone, no Ngāi Tahu ahau, ko Pokutaraki Takamarae, ko Hauti Manahautu, te whānau I roti te whānau o Ngāi Tahu Holdings, ko Sam Inglis taku ingoa. As Sam introduced me, I'm currently the acting COO of Ngāi Tahu Holdings, but probably of more relevance, I was the General Manager of Investment for about 3.5 years, and prior to that I spent about 8 years with the New Zealand Superannuation Fund. So I guess that's the most relevant of my background for today, talking about investing, etc. So just looking forward to having a discussion and answering any questions you may have. Kia ora.
Tēnā koutou katoa, he uru tēnei no Ngāi Tahu, no Ngāti Kahungunu hoki, no Tutahi au, ko Kendall Flutie tōko ingoa mea koe te kahanga o Banker. I've got a background in accounting and software development, which led me to co-founding Banker, which is a financial literacy software. It's a platform that's used throughout New Zealand and in Australia. Really proud to have supported over 300,000 rangatahi on their financial education journey. It's a real privilege and a passion of mine. Outside of that, yes, I'm on the FMA board, also on a disputes resolution scheme board, so really passionate about ensuring consumer outcomes for our people, both in the preventative education space, but also when we need it most and when we're in vulnerable circumstances too.
Kia ora, my name is Paul Burns, originally from Dunedin, Scottish and Ngāi Tahu background, from Akaroa Aparima, way down south. My wife is a fierce Ngāi Tahu woman as well, from a number of different maraes around Banks Peninsula. I work at Craig's Investment Partners. I've been there about 10 years as a financial advisor, and before that I was in banking. Started at Westpac, National Bank, ANZ. I've got about 25 years of experience there, so I'm probably the oldest person on the panel. So yeah, it should be pretty interesting seeing what these young people have got to say. But yeah, please ask any questions. And if I talk too much jargon, just put your hand up and go, hey, I don't understand you. Thank you.
Thanks, all. Oldest and wisest, but we'll find out. We'll build on that, what you mentioned about jargon. So I think there are a lot of, financial concepts can be kind of foreign to some people and overwhelming. So we're here today to try and kind of simplify that for you. So as I say, feel free to answer any questions because we don't necessarily know what you want to know. So we'll do our best though. So we'll start off with just a bit of a kind of investing or financial markets 101. And then we'll kind of move through to talk more about the kind of where we see the kind of future of finance going. So I might start with you, Sam, if that's okay. So maybe you can answer the question kind of in the context of your 8 years at New Zealand Super Fund and a good few years at in the investment team. So yeah, just a simple question to kick things off. Can you just give us a quick overview of financial markets and how they work?
Yeah, I had to go and I had to think quite carefully. What is a financial market? And I think jargon's probably the key key issue, right? Because it's actually really simple. It's just like any marketplace where things are bought and sold, but it's just marketplaces where financial instruments or securities, which is complicated in itself. What does that mean? Are bought and sold. So there's all sorts of them. There's equity markets, where you buy and sell stocks or shares in companies. Foreign exchange markets, where you buy and sell currency, international currencies. There's bond markets, where you buy and sell debt. There's commodity markets, where you buy and sell steel, pork, whatever it may be, milk powder. And all the way through to more complicated things like derivatives markets, where you might buy pork in the future, for example. And so if the financial markets are, any market where you buy and sell a financial instrument. The second part was how do they work? I'm not really sure. That's probably a really long, complicated discussion. But, two simple ways. There's public markets, like listed equities, where you can see the lists and the price of the stocks, and everyone can go and have a look and see what they're buying and selling for and go and buy one and sell off it. Or then there's private, or what's called over-the-counter markets. But that's essentially, again, a lot of jargon to say you and me will strike an agreement together to buy and sell something, and it's all done privately. And in their essence, they're really critical for the functioning of a capitalist society, I guess. It allows capital or money get allocated to the most productive source, so whoever needs it the most can access it by raising funds. They can buy things that they need. People can provide liquidity, i.e. you can get cash when you need it, you can sell your house. So actually they're sort of just a critical part of the functioning of the society we live in, but as we started with, they get wrapped in a lot of complicated jargon that can make them relatively intimidating and more than they need to be.
And you mentioned a share, for example. So I won't assume that people necessarily know what that is. So in simple terms, how can you describe what a share is?
A share is a small little ownership percentage of a company. So, a company may be split up into 100 little ownership packages, and each one will be called a share. So if you go and buy one share in that company, you will own 1% of that company.
Cool. Thank you. Well, I might pause. Are there any early questions from the audience? Excuse me, about that? Is there any kind of other? Because we say I don't want to use jargon, but then maybe there were a few kind of jargon terms thrown in there. But I'll note it is kind of very hard to describe some of these things without using jargon, because just the nature of it is very complicated. So are there any questions initially? Yep. Yeah, go for it.
If someone wanted to buy shares or bonds, can you do it yourself, or do you have to go through someone else?
You can do it yourself, but it's always been relatively complicated. And even someone like me, and we're going to get to this later, that you spend a lot of time in the financial markets. Actually, often it was just too difficult and too challenging, because often there's intermediaries you need to go through, brokers, or to get direct access to the market and the like. And we're going to talk later about a lot of the evolution in financial markets, and really what that's making is making it easier to access. So platforms like Sharesies and many others, where you can now just jump on those quickly and easily and buy shares or bonds, etc. access yourself.
If you get someone to do it, a broker, they charge you a percentage, so it's costing you again. And if you could do it yourself.
Yeah, no, that's a good question. And then actually, without lying, that was going to be my next question. So, well, I kid you not. So I was actually going to. Thanks for that, Sam. I was going to ask Paul.
I won't ask you.
Oh no. I'll be going back to you. What was your name, sir? Oh no, you don't tell me. Good call. So I'll go to Paul. So I was going to actually ask a question. Like there are lots of different ways you can invest. Some might cost a bit of money. Some might be digital, some you might actually go and physically talk to someone, and there's obviously a rise in prevalence of kind of online platforms. You may have heard like of Sharesies, for example, or that sort of thing. So I was going to ask you, Paul, can you give us a rundown of, just from your perspective, like different ways you can invest? And bearing in mind, Paul's actually a financial advisor, so hopefully his answer won't just be come and talk to me, but we'll see.
No, just to answer your question, you have to go through an organisation to buy a share or a bond. you cannot go to a company and buying it direct.
But New Zealand government bonds,
You still have to go through a registered financial provider to buy it, unfortunately. Yeah. Yeah, the different. I think before you look at sort of investing, you've got to ask yourself why you're investing. What are your time frames? So, if you've got $1,000 but you're going to use it in a year's time, you want to leave it in the bank. You don't want to have that risk of buying a share and then losing 50% of it. So, think about your time frames and think about what sort of risk and return. Kendall, like this from Financial Market Authority. Think about what sort of level of risk and return you want with your money. There's no such thing as a free lunch. If a company's promising you 10% dividends being income from that investment, there'll be a little more risk compared to about leaving it in the bank and getting 3 or 4%. So think about timeframes, think about what sort of level of risk and return. Quite often when I see clients, they'll go, Paul, we want the highest return you've got, but we don't want any risk. So that's impossible. The higher the risk, the higher the return. What are your objectives? What do you want to achieve by investing? Do you want to save for your retirement? Do you want income from your investment? Is it for your kids' education? So you can do a lot of these things on platforms online, sort of tick box, and then it'll give you an answer. Should you invest? Should you not? What should you invest in? And then I think it's getting really confusing on the vehicle that you use to do that these days. And it depends on how much you've got to invest. So if you've got a smaller amount of money, maybe I'm using just a figure here, and I don't know your personal situation, but say it's below 10,000, I would probably think about investing in managed funds. And then that's jargon. What is managed funds? Managed funds is where you give your money to someone else to invest on your behalf. So they're going to make those investment decisions, and they're going to invest it where they see the best opportunity. So you've got to do your homework on the best managed fund for you. To invest in a direct share, buy shares or bonds, and buy 1 or 2 shares or bonds, it's really risky because you're putting all your eggs into one basket. For smaller amounts, I like putting it with a manager or an exchange-traded fund where it invests in an index, it's another jargon, where they invest in a whole lot of different shares, up to 1,000 shares.
if you're buying government bonds, though, you buying them at a set interest, like it might be 5% over 2 years. So that 5% is actually better than any bank can give you. If you're talking 10, 20 to 30,000.
Depending on where interest rates go and depending on how long you...
Not going to go up that high in the next
No, we were
2 years.
talking about it before. Interest rates are probably peaking, and buying a bond at 5% for the next 5 years makes a bit of sense.
You're getting a better return over a short period of time.
Banks are offering 6% for 1 year. So
Which bank?
Westpac. So maybe we can talk offline. But there's after the event. But you just got to really consider those factors. But there's some great online tools. I think Sharesies has probably got a good questionnaire to go through. But there's many different platforms you can use, managed funds like Milford, and so on. So hopefully that sort of answered the question.
That's cool. We can come back to it later as well, but yeah, no.
I didn't mean to give you a hard time.
Oh, no, you can give me a hard time.
No.
My wife does.
Exactly. Well, I might hand over to you, Kendall, now. I'll ask a slightly different question now, though. So Kendall does a lot of awesome work with our young tamariki and rakatahi and now adults as well. But I'll focus maybe on the younger people for now. Are you seeing that our young people understand financial concepts, or is there room for improvement?
Definitely room for improvement. I think, I'm not sure if this resonates with anyone here, but for the majority of people that we engage with, they never received a formal financial education. Sort of just assumed when we enter the financial world it'll all fall into place, and that's such a tough and unfair assumption, given that we have to engage with the financial world. And that's the case for the next generation as well. So they're not necessarily learning in a structured way. They are learning through osmosis, through observation. So they're learning from their whānau, their friends. They're learning from their devices. They're learning from peers, those they aspire to be as well. So it's quite a challenging system for our rangatahi to navigate from a financial education perspective, which is why part of the reason why we do what we do. The other challenge as well is the increasing sophistication of our financial system as well. So we've got different financial products coming out every day. Think like buy now, pay later. So that came in, 5 years ago, something like that, and just ripped through the young generation. It stimulated consumption and really changed how people thought about debt, and a barrier to debt had shifted as well. So we've got those pressures. I will say though, that's the average. On average, young people don't know what they need to thrive financially. But there are some awesome instances that we get to hear about and engage with where whānau take this really seriously. They put some parameters around learning about money at home. They're really open and transparent with their financial situation, and that can literally change that child's life. So yeah, I think we've got room for improvement, but there are a lot of awesome initiatives out there. The likes of Whairawa as well, like establishing those behaviours from a young age, and I know you have a strong focus on our rangatahi and youth, and it all makes a difference.
Yeah, not that we're necessarily trying to plug Whairawa tonight, but yeah, we do have a strong belief in the kind of intergenerational benefits of starting young. And Kendall's doing some awesome mahi in that space for trying to address that. Question?
Sorry, can I just ask a question? Are you able to, naivety, elevator pitch for Banker, please, for those of us
Oh,
yeah,
who
yeah.
might not know?
Yeah, sure. So we're a tech platform that simulates the financial world. So if you've ever played like The Sims or SimCity, a little bit like that. If you haven't, imagine your online banking and then add in your KiwiSaver account, add in the Taxman, add in the job market. Everything you do in the financial world, we've put in this little piece of technology, and you get to learn and practice and experience in a safe environment. So our rangatahi will come in, they'll build their knowledge through quizzes, they'll then put that into practice by like opening a really good high interest rate savings account, maybe getting some bonds or the term deposit, maybe investing in single stocks on the stock market, and that'll play out through their time in the classroom. In primary schools, it integrates with the classroom, so it actually can become like ingrained in their day-to-day life. I was telling someone earlier, they might become the classroom chair stacker or the rubbish monitor and get paid a salary for doing that, and then they'll have to pay to rent their school desks. Got to have both sides of the equation. So our pedagogy, our philosophy is that we build knowledge to build capability, to build confidence, so that those kids, those rangatahi, can put that into action when they have to engage in the financial world. Yeah, thank you.
Good question, thank you. I just noticed we actually did have a couple of questions come through on Slido earlier, so we'll cover those off first, and then we'll move on to the future of financial markets and investing after that. A couple of good ones, actually. So the first one, probably it might be a Paul, could be a Sam, could be a Kendall. I'll leave it open. So what is the better investment to create wealth for more choices and options in life? Property or shares? So there could be a couple of... Again, we're not giving advice tonight, but maybe I just want to talk in general terms around property and shares and the type of people that those investments might be more suited towards. Again, I acknowledge your point earlier, Paul, talking about investment time frame and that sort of thing. So who would like to kick off? Maybe the financial advisor.
Yeah.
Again, Paul's not giving advice.
No,
Yeah.
not giving advice. I think you can do both.
Yeah.
You can do both really well. You want to spread your money around, so you have a few baskets. One's your property, the one you live in. Have your whairewa, have your KiwiSaver, have your managed funds, and if you build up enough equity in your property, investment property is definitely, in Kiwis, we love our property. But just something to consider with property is there's added stress, there's tax issues, and a lot of regulation issues. Things can change. we're coming up to an election soon, and property is going to be under the microscope, investment property. So I'm a big fan of spreading your eggs around, diversification, and do both if you can.
Thanks, Paul. Does anyone else have anything to add to that?
Yeah, I mean, my perspective is probably a bit more personal, and again, it is both. You've just got to understand really why the purpose is you're investing, and everything carries risk and return over the longer term. From a personal perspective, my house is what I live in. I don't really consider it as an investment. I consider it as my home, so I don't really think of it in that way. And actually, my preference from an investment perspective is shares, because I actually have a large property that's sitting there anyway, and owning property carries a lot of risk, a lot of regulation, and when things change, it can go wrong quite quickly, because you've got to factor in the other side. You're taking a lot of debt usually to buy that house, right? So you've got little margin for error, and when interest rates charge like they have, a lot of people have been counting on increasing values of their home and not the rental stream. It's coming back to bite them. Saying all that though, if you've held a house for a long time, an investment property, you would have done very well out of it. So, like I say, it's understanding why you're investing, what risk you're taking, and putting a balance. So I think it's too simplistic to say which one. And personal preference, risk tolerance, all those good stuff that you start off will really come into it. How much you want to manage your property and people and all of that stuff as well.
Perfect. All right. Cool. I might ask the second one. This is an outstanding question. I think Claire in the front row. No, I'm just kidding. What are some ETF options for investing more sustainably, socially responsibly, with a time frame of 15 to 20 years? So very precise. But would you give that a crack around ETF options, or you may just want to talk about more general kind of responsible type investment options as well?
So it's more ESG.
Yeah,
focused.
ESG focused.
There is so many options in explain what an ETF is. It's an exchange traded fund. So that means you can buy one share, if you remember what Sam said, one share in a company that invests in companies that have good ethics, that focus on renewable energy and have good governance. And that ETF, or exchange traded funds, tracks the performance of that basket of companies there. Just one thing I've observed being in the market for a while is you've got to be careful about greenwashing. So that's companies who say that they do good and they have a great plan, a great strategy to reduce carbon in 20 years' time. But it's just a plan and nothing's proven. We've got one of the biggest resource and mining companies in the world qualifies for a lot of these ESG funds because they've got a great plan to reduce their carbon, and they're the biggest carbon emitters in the world. So I'm just really, you want to have a look underneath the bonnet and just do your homework. But there is thousands of ETFs out there, but again, you have to use a broker or an intermediary to buy it for you. And they should be able to give you a one-page fact sheet on it that just explains a bit more about it. Hopefully that answers that.
Cool. Thanks, Paul. All right, well, we might move on now to the future of financial markets and just kind of focus on some themes we think will be relevant. First, I might go to you, Sam, then to Kendall, then to Paul. So firstly, Sam, we've obviously seen a lot of volatility over the last 5 years, or last few years in particular. Like we've seen COVID, we've seen high inflation, we've seen wars in the Ukraine, etc., etc., etc. And obviously the media like to pounce on those sort of things and do a bit of kind of fear mongering. So obviously advice would be not to panic, but what kind of reassurance or what kind of future mindset would you encourage for people to have and to respond to those sort of things, to reduce their kind of anxiety levels?
Yeah, just really stay calm. Again, it all comes down to why you're investing, the time frame you've got, and then what you're using to achieve those goals. So let's say if you're saving for a house that you want to buy in a year's time and you've got a whole massive deposit saved up, it would be a ridiculous idea to go and put that all in the share market, or even worse idea to go put it all in cryptocurrencies, right? Because they could, in the share market it probably won't disappear if you go broad enough, but it could go down 30%, for some of these things play out, you know, a significant portion could disappear. Cryptocurrency, it could all go away. So in that instance, you know, just put it in a bank account, a term deposit, where you're earning a nice 6% return. And then if you've got a long term and a long horizon, and you've got a lot of time to ride out volatility, that's when you start looking at. Personally, I wouldn't look at cryptocurrencies, but at things like equities, where you can take the ups and downs of the share market. You know, we talk about a lot here at Holdings. We made a significant listed equity, you know, share market investment a number of years ago, and asked about the risk of that investment. And as I look across our whole portfolio, I'm like, well, that's the one thing I can say with a lot of certainty is going to be worth a lot more in a generation's time versus everything else we have, because everything else is concentrated, it's a big risk. So again, if you've got a long investment horizon, diversify it. The easiest way to diversify is to go and buy a broad basket of equities, and you'll just ride the cycles. It'll feel horrible at times, it'll feel fantastic at times, but long term, you'll be all right. So it's stay calm, understand why you're investing and the time frames you've got.
Sounds good, thanks, Sam. And Paul, obviously, you would have discussions all the time with your clients, like markets go down, they'll say, you know, why is my portfolio gone down, Paul? What are you doing? You know, you're stealing my money. Like, how do you respond to that?
Yeah, well, in real terms, if you remember COVID, the stock market around the world dropped by about 30%. So I was working from home and taking a few interesting calls. It's all about, as Sam said, time frames. So, you know, your portfolio investors may have dropped 30%, but are you needing the money right now? No. Okay. Well, you know, what are your time frames? 10 years. Okay, well, it'll recover. During COVID, markets dropped 30%. Within 2 months, they were back to where they were. And then within a year, they were up 50% from there. It just shot away. We went too fast, too quick because of low interest rates. But, you know, during that period of 30% low, what you should have been doing was adding to your investments. If you've got a long time frame, it's like you hear Briscoes, everything's on sale. That's when shares are on sale. When you hear them down 20, 30%, that's when you should really think about adding to your whārawa investments. You know, I'm sure Sam wouldn't mind taking extra deposits. That's when you put money to play, is when things are down. I don't know where shares are going to be tomorrow. I don't know where they're going to be next week, next month, next year. But I know over a long term, they will outperform most assets, property, bonds, government bonds, cash. They will outperform most asset classes. But it's the time frames that are important.
Thanks, Paul. Thanks, Sam. Right, over to you now, Kendall. Obviously, there's a big increase in digitisation, and including your software itself. And we're seeing kind of less reliance on cash and just prevalence of information. You know, you kind of see people go to YouTube or TikTok and try and kind of figure things out themselves. Do you see that as a good thing for a young tamariki and rangatahi, or are we on a slippery slope?
I don't necessarily think it's black or white. I think it's a reality, the digitisation of our world, and the way in which we engage with information. I think that toothpaste is out of the tube, not going back in. But from a research perspective, losing the physicality of money certainly hasn't helped us learning about money. So if you think about your babies, like, they like to touch things, they like to put things in their mouth. And part of learning about cash, that physicality, the tactile nature of it, actually really helped us learn about money. So we've lost that, and therefore money has somewhat become invisible. I've heard some stories where kids forget money growing on trees. They think it grows in an ATM, or you can just tap, and they don't really make that connection that their parents are going to work and money goes into their bank account because it's invisible in nature. So that's really tricky, and that's definitely a negative. But that doesn't mean there's no solution, and it doesn't mean we have to bring back cash, although some people actually do. Some people who are budgeting will actually get cash out and, you know, put that physicality back into their lives. All we have to do is make money visible again. And so for our rangatahi, that means letting them see it, letting them engage in it, getting them to understand the flows of money in and out. So as whānau, if we can bring money up on a screen to our tamaiti, our tamariki, that really helps draw those connections for them. And then why not lean into the good stuff? Like, they're on social media, who knows who they're following. Get them to follow a few cool people who talk positively about money, not necessarily influencers, but people who are reinforcing the behaviours that we want them to see as well. So I don't think it's good or bad. I think it's the reality of our situation. So how do we adapt to make it as best as possible for our tamariki?
Sounds good. Thanks, Kendall. Yeah, definitely about embracing change, isn't it? What about from your perspective as well, Paul? Like, how long have you been an advisor for again?
Since 1998.
Like nearly
financial
old enough.
advisor, and, yeah, I'm ancient.
So over
yeah.
that time, what have you kind of seen in change for kind of how people kind of self-serve, or what are they kind of expecting from you today in terms of, like, are they wanting more digital solutions? Do you have a range of cool tools that you take them through, or are you kind of doing away with paper? Like, I'm interested in your kind of how many every years that is the change of.
I was told when I started banking in the early 90s that paper was going to disappear, but it's still there. I do like printing out a lot of paper. I shouldn't. I do. I think every age group is looking at technology. I think of my parents, and during COVID, Dad loved going into a bank branch and talking to the teller and getting his cash out, and tried to talk about internet banking. Oh, no, I can't do that, won't do that. And then COVID hit, and then my kids showed him how to use it. And he hasn't gone back. He's never gone back into a sort of bank branch. And I think more and more people are using online tools. The only thing that worries me, and it's to all of you here, is be careful of fraud online, texting, emails. If it sounds too good to be true, you know, it's very dangerous. My wife got caught out the other day, just thought she was buying something online. So we want to embrace it, but there's got to be controls and safety checks around it. But there again, I think people still want to talk to someone, you know, and it's really hard. We were talking about it before in my industry. You know, there's not too many people in my trade, financial advisors, that talk about investing. And, you know, people need that. They need a bit of guidance. So it is hard. But there's some great online tools. But I could do a whole session on fraud and things to watch out for and so on. So just, if you get an email or text, first thing is, this is a fraud. Think of it that way. Don't think of it as this is an opportunity to make some easy money.
Fully agree. Question.
What are the best assets to invest in that sort of protect against inflation?
There's a number of assets. Probably shares, a logical one, growth shares. So shares that grow in value and don't pay out income. Gold is an inflation protection tool. You can buy inflation-linked bonds. So, you know, you invest in the government bond. I use that gentleman's example, a government bond for 5 years, and you're paid an interest rate of 3%, say, every year. That can go up or go down with inflation. So there's shares, gold, and bonds that are inflation-linked there. Hopefully that answers that.
Thank you from the audience. We have a couple of anonymous questions as well come through Slido, so thanks very much, guys. It's good engagement. This is probably more for you, Sam. What are the key metrics to consider when choosing a fund manager? For example, fees, experience, digital, ESG, you know, that sort of thing. What do you look out for?
I mean, from a personal perspective as well, I think if I'm investing personally, actually passive is best. So, you know, I'm a big fan of ETFs, exchange traded funds, or large passive indices. So really, again, it's selecting what kind of risk tolerance you have and what sort of assets you're wanting to get into, and providing the biggest and buying the biggest and the cheapest in my mind. So they're tracking the market, so they should return exactly what the market does, and therefore, again, the lowest cost one possible. Beyond that, if you're wanting to be a bit more active, you know, just actually a long-term persistent track record, which is really hard. It doesn't exist. That's why I really believe in passive, right? There's thousands and thousands of people out there trying to do this in the world, and all the evidence points to underperformance after fees. but a long-term persistent track record. But you've got to be careful with that as well, because that's often attached to particular people, and those people can shift. So that's where you've got to get in under the covers to a degree. Like below, you may go to Milford. They've got a long-term track record of outperforming, but a particular portfolio manager might leave Milford and shift elsewhere. So they might have just lost their secret sauce, for example. So I think it generally it's really hard at an individual level to find on large listed markets. For in unlisted markets where you're talking about private equity and the like, which again are much more difficult to get into as an individual, unless you're very high net worth. There's a lot more factors that you can look at, and a lot more where experience and past success can really prove, and actually networks and the like, because once you've done well, you tend to attract further success.
Cool. Perfect. Example. I've got one more question from Slido, then we might go back to explore the digital side a bit more. So this question, another good question. So it's, what are our Whairawa accounts investing into, and how socially responsible are they? It might actually be a question for me, so I'm not on the panel, so let me just slip onto the panel quickly and then I'll slip back off. Firstly, I know the Whairawa portfolios or funds are heavily... So we have 3 funds. We have a conservative, we have a balance, and we have a growth fund. They're all heavily diversified managed funds. So we've heard some of these concepts tonight, which basically means they invest into lots of different asset classes. So it could be global equities, there could be New Zealand equities, there could be some listed property, there could be some bonds, there could be some cash. Government bonds we're talking about before, so very heavily diversified, which is good. It's that kind of whole concept of spreading the risk, not putting all your eggs in one basket. So we're definitely a big believer in that. But in terms of the socially responsible question, which is great, so the portfolios we invest into are socially responsible portfolios. So they exclude some of those kind of nasties out there, weapons and animal testing, dirty kind of energy producing companies, that sort of thing. So we're a big believer in kind of making sure our investments align with our Ngāi Tahu values and that sort of thing. So that's something we spend a lot of time and effort on, making sure there's no kind of disparity. And if there is, we do something about it. So hope that answers your question. Conscious I'm not on the panel, so I'll drop off. Cool. Just going back to the digital tool side. I know, Kendall, you were talking before about it's here, right? It's not going to go, so you just need to kind of embrace it, but obviously with a bit of caution. I guess my question to you was, do you kind of see it leave the kind of rapid rise in this sort of thing, leaving like some whānau behind? And kind of what would your advice to people be when they're kind of grappling with all this kind of technological change, when people can get stuck in their ways and used to doing things a certain way?
Definitely. Left behind or potentially in vulnerable circumstances. Like if we address the left behind first, there's been a massive technological shift change in the last couple of decades. Or actually the last decade, the last year, right? Talk about AI. And unless you've been keeping pace, that would naturally feel pretty overwhelming. But there are ways to engage or re-engage. I'll tell you a quick story. My grandparents, who I love a lot, most times I go up, my nanny will ask me, like, what do you do again? And I'll write it down on the paper. So that's a pretty recurring thing. And then one trip I was up there, my granddad told me that he'd been on this bus and he'd learnt how to do online banking. And I said, was this bus called Dora? And he said, yeah. And this is a bus, one of our partners is Kiwibank, and it goes all around the country and connects with our kaumātua, our elderly, and uses our software, Banker, so because a pretend bank, right, to teach them online banking. And so it was just this aha moment where they finally knew what I did, and they also learnt an awesome new thing. So, and they're in their late 80s, so it's never too late to learn new skills. You do have to put yourself out there, but there are awesome organisations to support that. And otherwise, our whānau can be a great vehicle for that change and adoption of technology as we need to. I agree with the sentiment around scams and treading cautiously. I think those those who are treading into new technologies are often the most vulnerable of being scammed or a victim of fraudulent behaviour. And these guys are sophisticated. They know who they're targeting. They know how to act. So, yeah, my only caution is go in, have your guard up. I totally agree with your sentiment, Paul. It's all around trustworthiness. So the question is not, do I trust this person? It's, is this person trustworthy, and how have they proven that to me? But yeah, tech's here, and it's cooler when we learn tech together and we learn from one another.
Great answer, thanks, Kendall. Well, I think I heard you mention AI or artificial intelligence, so maybe we might just have a bit of a chat around that. Maybe, Kendall, do you just want to describe first what it is? Is it kind of robots? Are they going to take over the world, or is it something less scary?
Maybe both. Who knows? We're at this really interesting place on the technological adoption curve, and we've got artificial intelligence. So that is, I guess, technology whereby it's not thinking. Well, there's a bit of a debate whether it's as to its sentient, if it can think for itself, but it's technology that presents as human a lot of the time. So it appears like it's thinking, it appears like it can answer questions to you. This is in the applications we're probably most familiar with. So if you've heard of ChatGPT, something like that. But fundamentally, artificial intelligence is a bit of code that can do something in a really clever way, and it's not always in a predictable way. And the way AI works is it's fed a bunch of data. So it could be, you wouldn't do this, but all of the Whairawa customers' information from all of the history of time, and you just feed the machine all that information, and it learns. It actually learns. And the way it learns is by recognising patterns, and then it just gets really good at predicting the next thing in a pattern. So it's seen 8 million data points from Sam, and then I come and ask it a question and I say, hey, I'm 33, I've been contributing this much to my Whairawa account. When I retire, how much will I have? And it will say, oh, I've looked at these million people over the history of my data eating experience, and I know with quite a lot of certainty you're going to retire with this amount of money. That's an example of what AI could do. There's so many other things it could do. You've probably used it. Some of our stuff on our phone, like Siri, has some AI capability as well. And then we've got like AI in cars and all that sort of things that has them driving around. So it's really integrated into our everyday world. From a financial perspective, I'll maybe hand over to some of the other panellists, but it's going to be really interesting as to how this grows and adapts and gets adopted by consumers. I don't know if anyone has thoughts on that.
I'm pleased you answered that question. What's AI? A lot of my clients ask, how can I invest in AI? And there's a number of ways you can do it. You know, it's all about data and who owns the data. The winner, AI is really developed to create more efficiencies in our world. You know, when it first exploded earlier this year, a few clients emailed me saying, Paula, you're out of a job now. Maybe so, maybe not. But when you think about every day-to-day work, you know, our teachers are teaching our kids differently, you know, and eventually AI might come in. We're short of doctors and nurses. You know, that will take a lot of work off them if they can get the answers through AI for diagnosing injuries or illnesses. So it's all encompassing. So just on the investment front, AI, if you're going to try and find the next company that's developing these new chips, forget about it. And NVIDIA, who develops the chips that go into this data that makes AI, their shares are up, I think, maybe 150% this year. So forget about that. Data storage is going to be huge. So you hear often about technology that's held in a cloud. It's not really a cloud, it's a big factory holding big data servers. and we need more and more of them. Microsoft, Amazon are coming into New Zealand, are opening these big data centres, so that's a good way of investing in that. But it's still developing, and whenever there's a trend, there's a big flow of money, you almost want to wait a while, let the dust settle, and then look at your investment options. But it is the next big technology sort of breakthrough, but it's very early days, and I think the regulators need to get a hold of this and just make sure we're doing everything for the right reasons. Not to scare you, there was a Microsoft employee who was in research and development that resigned from the company because he said at a time their AI actually did come alive, but you know, I'm not
He was
sure.
an interesting character,
Yeah.
but yeah.
Yeah.
But there have been really notable people who really spearheaded the research of artificial intelligence who have now said we need to pause and we need to take a breath. So, interesting space.
Question.
Yeah, sort of on that private equity space, how important are alternative assets to be part of your portfolio?
Yeah, I think Sam probably is the expert in this, and Ngāi Tahu have made some great investments in that area. You do need to have more money, unfortunately. Normally the minimum size to invest in private assets is $50,000 minimum for sophisticated investors, so it's really hard for people out there to invest. But you might be investing through your KiwiSaver. They've probably got an allocation of your money into private equity, so you're probably already playing that market. But it is super hard to invest. But just have a look at your KiwiSaver. I'm sure they've got an allocation to alternative assets or private equity. But it's not without risks. I mean, Sam could probably talk about the risks involved.
Yeah, I mean, again, I think from a personal perspective, actually trying to access that is a fool's errand, and you're just putting yourself in a higher risk, and you probably can't get access to a lot of it. Like Ngāi Tahu Holdings, basically our whole portfolio would be described as alternative. You know, if you own an investment property, that's kind of an alternative asset class as well. So a lot of people will be doing it, but when you think of private equity and the like, doing it from a personal perspective, it's challenging, they're pretty closed, and you're just taking on a lot of risk. It's only really in the world of large investors, it's actually pretty critical, because it is one way they can generate outperformance or lower volatility, you know, lower swings in their portfolios. So as Paul said, if you've got a KiwiSaver, your KiwiSaver, because they are large investors, are probably invested in those asset classes on your behalf. So again, I think large investors critical when you're a smaller scale investor. Actually being in a managed fund and the like, you will gain access to those sorts of assets, and it's probably the more appropriate way to do it. You know, because often private equity, it's a leverage, so more jargon. It's just a higher risk way to access public markets, and it buries out some of the noise of the public market. So you don't necessarily see all the risk that you're taking, and compound that, they're liquid. You can't get your money out when you need it. You give it to an alternative investment. Sometimes you literally might not be able to get it back for 10 years, or if you want to get it back, you need to sell it to someone, and you'll have to sell it for a lot less than it's worth. So they can often create more problems than they're worth, and there's better ways to access it as an individual.
Still some amazing opportunity. You know, Tesla started out in private equity, Spotify, Uber, you know, a lot of these companies that disrupt normal traditional investment come from private equity, but yeah, it's really hard getting into it.
Funds, the private equity funds.
Yeah,
That's another way. Yeah.
Cool. Yeah, no, it's definitely a increase in KiwiSaver providers having an allocation to private assets or alternatives, but there's a lot of things you need to consider though around like liquidity, portability, being able to strike a unit price. I could go on, but I won't get too technical. But yes, well, I might just have one or two more questions. It's conscious of time as well. I'd like to. Oh, I've got a question from the audience.
I had a question that
part-time.
leads on that topic we brought up earlier around traditional versus like new means of income growth, and also touched on the idea of kind of scams. If we think of scams, right, I think of like someone giving you a call, and as I think of the way with the new financial products coming out, stuff like Traders Domain, where it looks really good on the surface, trust, but he's obviously hustling that. I wonder what are some red flags? There's a lot of hunger for asset growth and financial growth in this room and in the community. What are red flags people should look out for in those maybe non-typical financial options? Where they might be too good to be true, even though maybe they haven't proven to be so yet.
I'm not familiar with the examples you're talking about. So.
Yeah, I think the Financial Market Authority have got very good websites available to check if it's a scam or not. So that's the first place I would check. Talk to a friend who you trust is another great place to just check it out, see whether it's for real. But again, if you don't understand what they're doing with your money, I don't understand cryptocurrency, Bitcoin, how it works. I've tried to. If I don't understand something, I don't invest in it. So, but the Financial Market Authority is the first place to go. But just talk to a trusted friend or family member is a great place.
I do think the sniff test just holds up though. Like if something is too good to be true, then it's probably too good to be true. We're sitting here in a room talking about, you know, the difference between 6% and 5%. If someone's presenting an opportunity for 10% and they can't articulate how they're outperforming so remarkably in this market, then I think you've got to trust your instincts. The other thing is, like, look at the people behind it. If they're personalities and they're not necessarily experts in that space or that domain, that's another red flag for me. Like, nothing against sports stars, but if someone is paying an athlete or a face to promote whatever said financial instrument might be, why are they needing to do that? Another thing for me, I agree, if something is overly complicated, you're not the dumb one. It's overly complicated for a reason. And if they can't answer your simple questions, then that's another red flag. But yes, the FMA website does have a nice list that you can access. But just trust your gut, like that sniff test. That's always really worked for me. And I've seen you cool things all the time, and I'm really pro-innovation, so I do want to adopt that new technology. But I try and temper my excitement when things look too good.
Good advice, thank you. All right, just in the interest of time, we only have 5 minutes left, so I'll just check if there's any other questions from the audience.
I'm about to retire this year and I have my nest egg.
Congratulations.
Yes, Kendall, does FIRA pass your sniff test? Where's a good place to be?
Fantastic question. No pressure, Kendall.
I am a FIRA member, so hopefully that answers that question. Yeah, and in terms of your situation, you're asking about ideas of where to grow and put in. I'm going to defer to the expert in the room.
We didn't put up a disclaimer tonight,
Yeah.
so yeah.
I can help with education, but actual...
I mean, without knowing your situation, the key things you think about is, you know, do you need some income from your investments? Time frames, what sort of risk and return? So it's a pretty hard question just to answer off the bat, but diversification's the key. You can still be in Whairoa fund, and you can draw an income from it now when they return.
Yeah, no. Once you 55 is the retirement age for Whairoa, which is 10 years younger than KiwiSaver. So
Oh, I'm not far away. Yeah, so but it's looking at everything, your KiwiSaver, you know, your tax situation, have you got kids, estate planning, and so I'd recommend you see a qualified financial advisor and sit down and just have a yak.
Or talk to some friends who have retired recently as well. Like, I do rate financial advisors, big fan, but at the same time, not everyone can access that, or it's not necessarily right for their circumstances. But if there's someone in your network, whānau, friends, colleague that you admire, I find that people are often really willing to share their stories, for good or bad, you know, bad circumstances we can all learn from. And then we need to contextualise, you're so right. Someone's story may not be quite aligned with your story. You just need to add your personal touches in there. Congratulations again.
Down the back.
As you were part-time, so when you talked, like, I recall my daughter did banker when she was at primary school, and I remember she was like, I'm the banker mum. and I like control the funds.
It's the top job. Only one person per class, so well
she
done.
was like quite proud of that. But fast forward and I see like for rangatahi, so that 18, 19-year-old age group, and that concept of like money and just they want things in Maya Tormune, so they want it in right and then they don't seem to really value money because like they've grown up with you know, I remember my son just took my card. He goes, "Oh, you just tap it, and it works." And mum's card pays for it. Like this is under $80. You know, the fish and chip shop or like so. How for a parent who has growing teenagers, what words of advice can you know, like for example, they're at university, you know, the possibility of you know the future. That you know they worry about their future. They do worry about their future of you know, can I buy a house without mum and dad's input? Oh, where am I going to live? That environment. Like, what are some tips to like give to rangatahi that have left home, like 18, 19, 20? You know, that some of my son's friends didn't go to university because they don't want to loan. And,
We hear that.
and my one was, well, there's good debt and there's bad debt. And getting a debt to get your education is a good debt currently in this country, but you know, I'd rather have that debt than your 22% credit card that you use and just buy on the weekend. But like, yeah, what would be some like tips to encourage like better money management for those ones that have left school?
Such a good part, and I get that disconnect between the way our rangatahi live in the moment and then their anxiety around the future. And it's really tough because that's those marketing forces at play, that's that social pressure forces at play where we've got to live up to a certain appearance or we're accustomed to a certain way of living. Something that helped me in my understanding around this disconnect was, as humans, we struggle to picture ourselves as double our age. So if you've got a 10-year-old, they can't imagine themselves at 21. So your 18-year-old is currently not thinking about their 65-year-old self. So we're not actually kind to our future selves. So the best tip for grappling with that is thinking about ourselves tomorrow, next week, in a year's time, and what aspirations we have for that person, that version of ourselves. So goals, basically. And what are we willing to sacrifice today for that person tomorrow, a week's time, a year's time? And we need to build love for that future person. We don't have it typically because our minds aren't quite wired that way. We're naturally wired to survive today and worry about today or serve ourselves today. And then we do start worrying about the future, but we don't act on it. Someone once told me that there's no such thing as saving, there's only spending. There's spending today or there's spending tomorrow. So creating some of those behaviours about spending tomorrow for our future self has been, when I've worked with rangatahi, that's been a bit of a light bulb moment. It's tough. Research also says that our ingrained behaviours take 12 to 24 months to shift. So don't go looking for an instant change in them. Be patient with them and keep reinforcing that narrative. If that all fails, I'll give you my email address. Send them my way.
Cool, thanks for that. Fantastic part. Just conscious of time, if it's 7 o'clock and you probably all have places to be. So at this point in time, I'd just love to thank the panellists. So Sam, Kendall, Paul for giving up their time and coming along tonight. I'd also love to thank everyone in this room today as well for your engagement. I've been part of a few panels and I think this is the most questions I've ever had. So it's awesome. So thanks very much, guys. Round of applause.